Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to today's Cut to the Chase podcast. Today is Wednesday the 19th of October. I am Steve and I'm standing in for Daniel for the next couple of weeks. If you thought we had it bad, spare a thought for investors on this day in 1987. 35 years ago today, the US stock market, as measured by the Dow Jones Industrial Average, fell 23% in one day. This remains the largest ever recorded decline in US stock market's history. Of course, it was not isolated to the US. According to Wikipedia, 19 out of 23 major industrial economies saw their equity market decline more than 20%. The level of uncertainty Black Monday created must have been incredible and unsettling in the extreme. That size of move was unprecedented and of course had doomsayers out in force. In the immediate aftermath of the sell-off, panic seems to be the word that the top newspapers settled on as the best way to describe Black Monday. Measured against what happened on this auspicious day in history, in one aspect we are lucky. While we have seen significant market swings, they have not been close to the market dysfunction seen in 1987. However, I would argue in some ways we are less lucky than in 1987. First, there was no internet then. Therefore, people generally found out what was happening on Black Monday in the following day's newspaper. Meanwhile, the fact that it was concentrated in 1 or 2 days means the ability of investors to react was limited. Given the level of panic, it's difficult to believe that the average investor would be a buyer in the ensuing days. And while the US stock market made a new intraday low on the Tuesday after Black Monday, the Fed quickly responded by injecting liquidity into the banking system, which pushed interest rates lower. The stock market duly responded, stabilizing and moving higher on a multi-year basis. So a failure to react to Black Monday would have potentially saved investors from themselves. Compare that to today and it seems to be more of a slow motion train wreck. Markets, the last 2 days aside, appear to still be under significant pressure and sentiment has been very weak for coming up to a year now, and the coming recession is on everybody's lips. Meanwhile, we're able to check on the stock market performance and, depending on the type of investments you hold, the value of your portfolio on an intraday basis. As I've argued before, this is not necessarily a good thing, as every time you look at your portfolio, effectively you give yourself a choice of whether to buy, sell or hold. Given the emotional roller coaster we all experience when we make, or especially lose, money, this can lead us to sell at exactly the wrong time. It is important to remember during times like these that we too are living through history at the moment. Only 4 times out of the past 150 years have we seen both equities and bonds lose value, let alone the 20% markdown we've seen so far this year, or actually over 20%. Despite our concerns about the global economy, and we still have a 75% probability of a US recession in the coming 12 months, such a market performance is unlikely to be replicated going forward. Therefore, now is not the time to panic, but to kick the tires on your investment plan. See how you're aligned to it and make adjustments to improve your portfolio strength for the long run. I must admit, sometimes I feel like I'm focusing too much trying to hammer in the point of staying invested rather than nuances of the short-term stock market performance outlook or which asset classes we prefer. Of course, you can go to our Global Market Outlook publication to get more information on this. But the reason I'm focusing on this so much is I believe how you react in periods like this determine your long-term financial future. With that, let me call it time on today's podcast. I'm wishing you a very happy and healthy Black Monday anniversary, and I will speak to you again tomorrow.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.